Welcome back to your ultimate pit stop, Piston Pundit. The latest tariff wave from President Trump, 25% on heavy trucks, 30% on furniture, even 100% on pharmaceuticals, was meant to flex U.S. trade muscle. Instead, it's triggered a quieter but more dangerous shock. Canada, China, and Brazil are offloading U.S. Treasuries, striking at America's borrowing engine, while gold surges as the new safe haven. This isn't just trade friction, it's financial blowback with real consequences for markets, consumers, and industries. Buckle in. Here are the pivotal moves redefining the global economic order. America's debt engine, the hidden superpower under strain. For decades, the U.S. didn't need to dominate every trade fight to win the economic war. Its true advantage was the ability to borrow massively and cheaply. From less than $1 trillion in 1980 to more than $35 trillion today, debt piled up while investors kept buying treasuries, treating them as the safest collateral on earth. Foreign central banks, pension funds, and insurers snapped them up, enabling Washington to fund tax cuts, stimulus, and even wars without facing the brutal borrowing limits other nations endure. This delicate balance relied on two essentials: trust and liquidity. Treasuries only worked as the world's anchor asset so long as America's rules looked stable. But politics can rattle that faith. Tariff shocks, sanctions, or debt ceiling standoffs all inject risk. When confidence wavers, even small portfolio shifts can send yields higher, raising costs on mortgages, auto loans, and business credit. That's why today's foreign sell-offs matter. They target the quiet engine that powered U.S. growth for decades. And once that engine stumbles, tariffs become more than a trade tool. They become a financial accelerant, pushing us straight into the next shockwave. The tariff shock, from make them pay to they sold our debt. Tariffs make headlines with podium speeches and product lists, but the retaliation that truly stings often happens quietly in financial markets. In early 2025, Trump's sweeping tariff package slapped a baseline 10% on most imports, with steeper reciprocal rates targeting Canada, Brazil, and China. Sold at home as a fast track to reshoring jobs, the real outcome was more tangled: higher costs for U.S. manufacturers, snarled supply chains, and a new kind of counterattack. Instead of only counter tariffs, these nations trimmed their U.S. Treasury holdings. For Washington, that's no minor shuffle. Canada, once the dependable ally, China, the surplus recycler, and Brazil, the commodity heavyweight, all sent the same message: weaponized trade and finance can strike back. A coordinated pullback drives Treasury yields higher, which filters into pricier corporate borrowing and costlier car loans. For the auto industry, that's a double hit: tariff-driven input inflation plus higher financing. The lesson is blunt: America's partners can make it pay quietly every month. But tariffs and debt aren't the only tools of quiet rebellion. Some nations are reaching for something much older than bonds or currencies: gold. Before we delve deeper, do us a favor. Smash that like button and subscribe to Piston Pundit. It helps us reach more auto enthusiasts and policy watchers just like you. The silent rebellion: gold steals the spotlight from treasuries. When trust weakens, investors turn to assets immune to politics. Enter gold, the ancient hedge with no counterparty risk. Since 2022, central banks have been buying at multi-decade highs, and by 2025, gold prices smashed records. For the first time in decades, some official reserves now hold more gold than U.S. Treasuries. That's not just a price spike, it's a structural shift. Three forces drive it: sanctions risk, highlighted by Russia's frozen reserves in 2022, policy volatility, from tariffs to debt ceiling showdowns, and portfolio math, as rising prices force managers to buy more to maintain ratios. Private flows add momentum, with ETFs, retail bars, and miners all rallying alongside. This doesn't signal the dollar's death. The greenback still dominates global trade and finance. But the margin is shifting. More gold, a touch of euros, some renminbi. The result? Not collapse, but erosion. Trust in treasuries as the lone safe haven is thinning, replaced by diversified reserves in a fractured world. And this new preference for hedging becomes even clearer when we zoom in on three of America's biggest partners: Canada, China, and Brazil, each with its own unique playbook. Canada, China, Brazil, different paths, same warning. Grouping Canada, China, and Brazil together misses the nuance. Each has its own strategy. Canada, long the dependable ally and steady treasury buyer, trimmed holdings in 2025 as a pointed response to tariffs on steel, aluminum, and autos. While Ottawa hasn't piled into gold, Canadian portfolios have diversified globally, signaling that alliances aren't one-way streets. China's approach mixes geopolitics with currency defense. Beijing has steadily reduced treasuries, built gold reserves, and developed alternative payment networks to limit exposure to U.S. sanctions. Selling treasuries also equips the central bank to defend the yuan when growth falters or capital flees. It's not abandonment, just recalibration toward autonomy. Brazil's calculus is different. As a commodity powerhouse, it needs stable markets and financing. Tariffs trigger reserve shifts both as insurance and protest. At home, Brazil grapples with illegal Amazon mining and gold smuggling, even deploying gold DNA tracing to clean supply. Three motives, one message. Over-reliance on the dollar looks dangerous, and hedging is now mainstream. And when central banks hedge, it doesn't stay in policy circles. It spills over into everyday life, especially on Main Street. The ripple to Main Street: cars, credit, and the new cost of capital. What does a central bank's portfolio shift mean for someone buying a car in Ohio or running a parts shop in Michigan? Financing. When foreign creditors trim treasury purchases, Washington must lure buyers with higher yields. Those yields set the baseline for auto loans, dealer financing, supplier bonds, and even the math behind new EV platforms. Add tariffs, and the squeeze tightens. Imported steel, aluminum, electronics, and battery materials all cost more, while higher interest rates inflate monthly payments. Dealers face slower sales, manufacturers juggle shrinking margins, and consumers hesitate. Even ICE vehicles aren't spared. Globalized supply chains mean parts and equipment cross borders multiple times. For investors, this mix of higher costs and policy volatility discourages bold bets, favoring shorter cycles and good-enough tech over risky, capital-heavy projects. Hybrids or efficient ICE models may gain ground if EV price parity drifts further out. In the auto world, a few basis points can decide: upgrade a plant, launch a model, or shelve it. And that's why this story closes with a verdict that's about more than trade. It's about America's financial future. Verdict: the Golden Rebellion, America's debt engine under siege. What started as tariffs on trucks and steel has morphed into something far more systemic. Canada, China, and Brazil didn't just push back with counter tariffs. They pressed on America's most sensitive brake pedal, its access to cheap credit. At the same time, gold has roared to record highs, overtaking treasuries in some central bank portfolios for the first time in decades. Trump's tariff play, meant to fortify America, may ironically accelerate the weakening of the dollar's dominance. The real question isn't whether jobs return, it's whether America's partners will keep funding Washington's endless borrowing. This quiet rebellion is unfolding one treasury sale, one gold purchase at a time. Whether the U.S. recalibrates or clings to the old order will define the road ahead. Now, we'd love to hear from you. Do you think America can keep financing cheap credit while tariffs shake global trust? Will gold really dethrone treasuries as the go-to safe asset? And closer to home, how do you see these shifts affecting car prices and financing in the next few years? If you found this breakdown useful, don't forget to subscribe to Piston Pundit and ring the bell so you're first in line for our next vehicle update and global auto industry deep dive. Share your thoughts and experiences in the comments. We'll be reading them all. Thanks for watching and see you next time. You can now check out any of the videos on the screen. There's plenty more to explore.